Let's talk about real estate, specifically the REIT space. You got Blackstone REIT buying WTP Industrial REIT and a multi-billion-dollar deal. Now, you might be wondering, REITs, what's going on here? Well, this is an industrial play, so it means warehouses. It means the places where the goods that we've ordered online for the pandemic have been flowing through, and clearly Blackstone REIT sees opportunity here. Let's bring in Jeff Olin, the CEO of Vision Capital, for more on this. And Jeff, I find it interesting, and I know this is sort of the ethos of Vision Capital as well, but you're pointing out it is much cheaper, and this is what Blackstone REIT understands, to go buying real estate on the market than it is to actually buy that physical real estate.
Yeah, I mean, this has been a long-term trend and opportunity, and as you touched on, it's the core of what we do at Vision, which is buying real estate cheaper in the stock market and the property market. You know, there's 4 or 5, I think, big picture takeaways that your audience can take from this. The first we just touched on is, you know, it's a $15 trillion market in the United States for private real estate. It's a $2 trillion marketplace for public real estate. And if you look at the value of all the real estate that some of these REITs own, and then look at what it's trading at and applied value, there's opportunities to do that. So we've benefited from 19 takeovers in the past 13 years for exactly that strategy. Blackstone's figured it out. This is the 3rd acquisition of a Canadian REIT Blackstone has done because of this reason. We'd rather not compete with Blackstone. We'd rather sell to Blackstone, and we've benefited from that. That's number one. Secondly, you've got low interest rates, so investors have a hard time making money in bonds. So the third thing is the capital. You're sitting on $360 billion of dry powder with the Blackstones, Brookfield, sovereign wealth funds, and pension funds increasing their weights from real estate because they can't make money in bonds from 5 to 10% to 15 to 20%. Private equity funds, fully funded, all looking to buy properties. And so REITs are one way to facilitate that. Then you add inflation protection, and you combine low interest rates where mortgage interest costs are low, and inflation. Real estate is a hard asset, and in their property prices go up. We may have an environment we've never seen in history, because typically when you have inflation, you have to match by higher rates. And if you have low rates and yet your asset values are going up, these are factors. And you know, you've got names like all kinds of names historically where you could buy U.S. real estate cheaper in the stock market in Canada because they're off the radar screen. And you know, my colleague Andrew Moss was on Market Call telling your viewers about WPT 2 weeks ago, and BSR REIT is another one. It's trading in the Toronto Stock Exchange, $14. And you look at where private market transactions are taking place and apply that to BSR, you're going to get a $17 share price. And so these are opportunities that your audience can have in the stock market.
What's going to be left, I guess, for our audience in terms of investing in individual names if a name like Blackstone REIT, which clearly sees the value, is going out and snapping them up?
Well, it's a big universe, as they say. There's a $2 trillion universe just in the United States. And in Canada, names that have benefited today and are still good value are Dream Industrial REIT, Granite REIT, where this bid is showing the value of their real estate. I mentioned BSR, it's in apartments, but that's a pretty safe place to be, benefiting from the same trends. And so this is, I mean, we've seen since IFRS accounting came into place, International Financial Reporting Standards in 2011, every single takeover that's occurred, and there's been a lot of them, have taken place at premiums to what these REITs said were their IFRS value. You look at today's transaction, a 50% premium to what the REIT published on its own of what their IFRS value, the market value of all their real estate less all their debt, it's being taken over at a 50% premium. And about a 35% premium as to what all the real estate research analysts said was the net asset value. And that's the opportunity by focusing on this kind of strategy can highlight for you.
Now, obviously, the deal today we're talking about is industrial REITs, and it's sort of the term industrial always seems so gray, but obviously there's something sexier happening underneath, right? The warehouse, so-called fulfillment center, the boom in e-commerce. Is this the most attractive space right now in the REITs, or are there other interesting areas too that could perhaps bear as much fruit?
When industrial is attractive, it's e-commerce, logistics, e-commerce sales as a percentage of total retail sales spiked to 25%. Starting last March. It's not going back to 6% anytime soon, even when people start shopping again. So, but it's because of the pandemic, this sector is also benefiting from two new factors. The first is the onshoring, the return of manufacturing to North America. I mean, none of us could rely on China for our pharmaceuticals, or Canada couldn't rely on the United States when Donald Trump blocked our masks at 3M last April. And so return of manufacturing is one result. And the second is additional inventories, where you need redundant supply chains. And these are all constructive for industrial real estate. But there are others. Single-family rental homes is a sector we like, and it's benefiting from the pandemic as well. You've got apartments, which are strong in the Sun Belt, and population growth. If you want to look at real estate, look where the jobs are. And the jobs are moving to the Sun Belt in the United States, and so that's why I mentioned BSR earlier. We like that name, as it's benefiting from that dynamic. So there's some other solid names and sectors that one can look at.